Hi, this is Matt Janino with Market Moves with Matt, and today we're going to go over the MACD oscillator and how I use that to trade. It is one of my top 5 trading technical analysis indicators, and it's really easy to add to your charts. And I'm just going to put this to the left, and I'm going to show you where it is. So the MACD oscillator is on the bottom down here, and it's basically two lines that are exponential moving averages, and one of them is moving slower than the other. So what you do get is these crossovers. So this point here is a crossover, and then here there's a crossover, and sometimes they are very close together, sometimes they're far apart, and it really makes no sense if you just look at it on the bottom of the chart like this. But I'm going to show you what I look for and how I make profitable trades with it. So I love buying something that just sold off, and I use the MACD to kind of validate that. So my strategy is to buy something that sold off hard because I think there's a lot of motion involved with that, and people aren't thinking rationally, and they're leaving some value on the table. So this is the daily chart of the S&P from about 2008, so you can kind of see the bottoms of the recession in there. And this is actually the monthly chart, but same thing, we get to see volume and the MACD, which is the most important things for looking at the MACD. So this bottom, that was the true bottom, was around 67 in the SPY. And when I go down to the MACD, you can see the two lines, the slower average and the faster one. And I like to wait for a huge volume bar, and once it is completely sold off and the volume starts picking up, you can kind of start seeing the bottom forming. And then I go to the MACD and I make sure that the two lines are pretty far apart. So right here, after it got sold off, started to form the bottom, you can see the MACD is very far apart. And the best way to make money from a reversal is when it clearly crosses on the MACD. So when you get a clear cross, that shows a lot of momentum. And when it does not clearly cross, like for example the sell-off in February up here, I can kind of zoom in for you. So in February we had the 10-year 3% scare, which sparked a sell-off, the two red candles, but the MACD did not cross. So that's how I know the reversal was not going to be momentous, and it wasn't going to keep going. I think it was actually going to stop, and we were going to continue trending because we didn't get the cross in the MACD. So when you get this bounce off the slower average from the faster average, that kind of means a continuation of the trend we were in. So we were in this bull trend for 10 or so years from the bottom of the recession. We took a break here, and then we got this bounce off on the MACD. So I think we're going to continue higher in the near term. But if I go back, you can kind of see we don't get too far apart on the MACD in any of these months, which is a good sign if you want to continue in a trend. Once the two lines get really far apart, that is where the money's to be made, in my opinion. Right here is the MACD distance is pretty large, so I'd probably be buying this dip, I'd be buying this dip. Once you see the tails on the candle form, that is when I like to buy. And then I go to the MACD to confirm it. And what I hope to do is I hope that these lines get closer together. So we'll zoom in here. So when we were selling off back in June 2000, we started to sell off and the MACD started to separate. And at some points, the MACD tries to move these lines closer together and the support levels start to form. And we get some buying, and then sometimes the sellers come in and push us back down. And then we don't get that move back to close the MACD. But at some point, we do cross, which is this point here. And that kind of means the end of a trend. And when we get that cross, it is kind of a momentum killer for a trend killer for whatever trend we're in. So that's kind of when this trend ended. And it's a pretty obvious sign because look at that reversal. It's almost a total V pattern. And then we get this jumbled MACD here where you don't see a huge momentum between the two because the distance is very small. So that means I wouldn't really trust this trend on it, honestly. And that is kind of validated by this huge drop in 2007. And the MACD totally separates there. Boom. But this huge separation, in my opinion, is an opportunity. I would be buying heavy when it's separated this much because look at that. The separation on the other side is huge as well, meaning the run-up was very good for the bulls. And we almost reached back to levels of pre-recession. And then we get the jumbled MACD for a while around here. And then we get our amazing run for the last 10 years. And you can kind of look at the MACD through that. So just like moving averages, I trade the distance between the MACD. I trade how they cross, how they bounce off each other. And basically, I use them pretty much just like the moving averages. And they're one of my top 5 technical analysis tools. And I really, really like trading off of them. I'm going to some other charts to see if I can find some other helpful MACD crossovers. Obviously, Friday, the June 15th, we had a huge crossover. Right here, crossed over. And if you bought this crossover, you would have made a nice profit. And you can kind of see that huge distance was just like the recession. This is almost exactly like how it looked for that recession crossover. So that's all I got for the MACD. I just wanted to show you a couple ways I look at it and the most important ways to trade the MACD in my opinion. I'm going to be putting out some more videos like this to share my knowledge in trading, so feel free to hit the subscribe button if you like them. Thank you.